Hi, everybody. Patrick Jackson with Mann Mortgage. Going into 2022, I wanted to do a little bit of a market forecast. We're about 2 weeks into the year. Rates have gone up every day. So I just wanted to look and see, what the experts are saying as far as, will they continue to go up as the year goes along? I'm going to be standing on the shoulders of greatness a little bit using a presentation from MBS Highway and Barry Habib. He's a leading expert in our field. Usually nails it pretty good and pretty good forecasting. We all kind of pay attention to him to see what trends are happening and stuff like that. So let's get to it. So 2021 recap. So let's look back at how Barry had looked at 2021, what he thought was going to happen, and what actually happened. 2021 interest rates, they expected them to rise at the beginning of the year and then fall as basically in the fall is when they kind of expected it. If I remember that at that time they were saying when the stimulus ran out in the fall, they expected rates to go back down. What actually happened was rates did rise sharply through March, and they actually recovered a lot faster. They recovered in the summer. They didn't wait till the fall. We gained most of our losses back in the summer. Housing. So the forecast was there would be a strong demand and tight supply, and that would push home prices up by a high single-digit percentage. What actually happened was there was definitely a strong demand and tight supply, but COVID made that even worse with labor shortages, supply chain disruptions. So that pushed real estate values even higher than they had forecasted. But they were, correct in that it would definitely go up, which I think we all knew. 2022 dynamics. So something to consider, the Fed is going to play a major role. What's going to shake out in both, interest rates and how that will, transition over to the housing market. So they'll be tapering. There'll probably be rate hike here hopefully soon. Different things like that. This can impact the equity markets. This is definitely what drives interest rates. It's going to impact housing as well as jobs. So with the Fed, their voting members rotate each year. So this year's board coming up, it sounds like, will be a little bit less accommodative than the 2021 board. So 2022 board, not as willing to accommodate. Fighting inflation is the main focus. That's what you keep hearing that word, inflation. We're definitely going through a bunch of inflation right now. So that's the main focus. Negative stock market reaction could cause the Fed to lose resolve. So if they try to fight the inflation and the stock market starts dropping really bad, then that might make them stop what they're doing, even if it might be necessary. So the take is that the Fed should have definitely done this hiked this sooner. Basically what they thought was this inflation was transitory. It was going to transition through. It was going to come and go, basically. That has not been the case. Inflation has continued to gone up, and now we're starting to see that affect everybody. So we're going to look back at history and see how inflation, how that has affected in the past, how the Fed has responded, and kind of use that to kind of predict what maybe 2022 will have in store for us. So going back, Arthur Burns was the Fed chair in the 1970s. He ignored inflation, which was rising rapidly. Some of you might remember this. He insisted inflation would be transitory. Sound familiar to what Jerome Powell has been saying. Year-over-year inflation ballooned from 7% in 1978 all the way up to 14% by the time he left in 1980. So that's what happened with Arthur Burns. Burns remained steadfast. He stuck to his guns. He said, "This is how it's going to be." He didn't back down. Higher inflation caused mortgage rates to rise from 12% to 18%. I've heard stories from people, building houses back then, doing construction loans, and 18% that would convert to 23%. So quite a big difference compared to the 3s and 4s we see now. 1980, Paul Volcker fights inflation. So he came in and he tried to reverse what Burns had done. So he hiked the federal funds rate from 11% to 20% in 2 years. He did pretty aggressively. Inflation dropped at that point from 14% all the way down to 5%. So what he did worked as far as inflation goes. But because inflation dropped, mortgage rates sharply declined from 18% towards 12%. So rates got way better, which is awesome. The consequences, though, the SBA 500 sharply declined by 30% during this time. So the stock market did not do well when he did this. Tighter monetary policy pushed U.S. into recession in 1982. So a lot of times, trying to combat inflation could lead to recession. And that's what happened in the early 80s. After that, Alan Greenspan, familiar name. Late 90s, inflation doubled from 1.75 to 3.5%. So not quite the 17 to 14 and that they were dealing with in the 70s. So higher inflation caused mortgage rates to rise from 7 to 8.5. So again, a lot higher than we're used to these days, but a lot better than they were in the late 70s. Unlike Burns, Greenspan took action mid-1999 and hiked federal fund rate by 1.75. So he basically hiked it to match the rise in inflation from 4.75 to 6.5 in a year. So he definitely hiked it. Inflation responded and dropped from 3.5% down to 1%, which is great. Mortgage rates dropped from 8.5 to 5.5, which again, great for me, sparking a huge refi boom. So rates drop, people, oh my God, we haven't seen rates this low in forever, so let's refi. There were consequences again, though. So familiar, SP 500 fell by 50% from the spring to fall of 2000. I'm sure a lot of you remember this. I was actually working in the .com industry about then, so I definitely remember it. My stock options became worthless. U.S. entered recession 2001. So again, got inflation down, got rates down, stock market dived, and we went into a recession again, just like it happened in 1982. So today, let's look at Jerome Powell. He's our current Fed chair. 2021 inflation increased from 1.75 to 7%. Powell thought, again, transitory. Higher inflation caused mortgage rates to rise from about 2.5% to all the way to 3.375. So again, rates went up. Let's see, they're tapering their purchase of mortgage bonds and treasuries. So they had started buying more mortgage bonds to kind of prop up the market while COVID was going on. So they're starting to lessen the amount they're buying. Will not hike and reduce purchase. So basically, they're not going to hike and reduce at the same time. They're trying to do this in segments. Done tapering in March, likely to begin hiking in May. So they're going to stop, as far as tapering off how much they're buying, they're going to end that in March, and they're likely going to begin hiking the rates, the Fed rate in May. Fed targeting 3 rate hikes in 2022 and 2 or 3 more in 2023. So as you can see, they're basically planning on over the next couple of years, rise that, move that Fed rate up quite a few times to try to combat the inflation. Let's see. So inflation and interest can still rise until the Fed acts. So right now we're seeing that. Like today, every day, like I said, rates have been going up. Today I've already got in another. We get alert to lock. So if someone had a loan about to close, we'd say, hey, rates are going up. They're going to be up tomorrow. Let's lock this loan before it gets even higher. So we're seeing that right now. Like I said, inflation's up. Rates have been up basically every day since the beginning of the year. Let's see. In general, like we saw in the past, if the Feds can tame inflation, then we should say our mortgage rates drop. So if inflation gets under control, they get inflation back to kind of where we need it, then we should see those mortgage rates, stop hiking and start coming back down to kind of where we were. But like it shows, it might be from a higher level. So instead of over this 2021, we got to high little mid threes or so and came back down. This time we might be getting up to the higher threes and then coming back down. So recap. So we're going to kind of look. So Bullard and Volcker, inflation 7 to 14, mortgage rates 12 to 18, Fed funds rate 11 to 20. Inflation response went 14 to 5. Mortgage rates went from 18% to 12, and the consequences: SP down 30% and recession. Alan Greenspan, again, 1.75 to 3.5, 7 to 8.5, 4.75 to 6.5, 3.5 to 1. Mortgage rates went down, after all that to 8.5 to 5.5, but SP down 50% in a recession. Jerome Powell. So we've seen what's happened so far. Inflation of 1.75 to 7, so definitely more than what happened with Greenspan. Rates were a lot lower to begin with, so they didn't go as high, but 2.5 to 3.375 is the base rate. If you're everything's perfect credit, all that kind of stuff. Fed funds rates, right now it's at 0. So you see 11 to 20, 4.75 to 6.5, 0 to 1. That's part of the reason why we've had such great rates lately. Is the Fed rate is so low. So we're expecting that to go up to 1% over the next year. When that happens, we should see inflation drop. That hasn't happened yet. This is what we're waiting for. We're waiting for the Fed to increase their rate and to see the inflation drop. And as we can see throughout history, that has happened. Again, just like inflation should drop, mortgage rates based on history should drop as well. That's what's happened in the past. Get inflation under control, we should see mortgage rates drop back down. Stocks expensive, economy slowing, recessions basically. That's what could be the negatives out of this. So stocks right now are at all-time highs. The economy is starting to slow down. Today I saw spending was down in December quite a bit, household spending. So there's a good chance, if we get inflation under control, that could lead to another recession. So wildcard, some things to keep in mind, besides the math and what's happened in the past. So COVID plays obviously is going to play a major role in what happens over the next year. We've seen it. I joke about you see something bad happen with COVID, and actually a lot of times rates respond better. So, major surprise could change the outlook dramatically. So if all of a sudden Omicron keeps going how it is, or we get some new crazy variant that's even worse and then locks everything down, we might actually see rates start to go down because of that. So we can't, that's a wild card, something we can't obviously know exactly what's going to happen, but that could change the forecast, depending on how COVID goes over the next year. Additional stimulus. So if Congress does get together and does another stimulus plan, what's happened in the plan, what's happened in the past is giving people more money. It could lead to inflation. It could push stock prices, higher. It could cause mortgage rates to rise further with more inflation. And if they did that, that's going to make the Fed's job, them trying to get inflation down, that's going to make it more difficult. So it doesn't seem like that's in the cards right now, but something to keep in mind. So run off of their Fed's balance sheet. So for the first step they're going to do is the Fed's going to stop purchasing new mortgage bonds and treasuries. So that's the paper. Next step is them rising that Fed funds rate, which right now is at 0, and we expect it to go to 1. They're still buying $70 billion a month in mortgage bonds and investments, which should help keep rates lower. If or when the Fed stops reinvestments, mortgage rates could move higher than previously thought. So if they stop doing that, they stop propping up the bond market, then we could say rates go up again. Stock market, not as interesting. It's something to keep in mind on, not as a little bit separate from the housing market and bond market, but basically at this time we could see everything's overvalued. All the stocks are all-time highs. We could probably expect to see things come down a little bit. So rate, and if they do hike rates, we can see the profit. We can see that start the multiple contraction coming down. So the price to earnings ratios could start coming down, resulting in lower stock prices as seen in the past. That's basically what's happened in the past every time we've gone through this process. So their forecast, MBS Highway's forecast, is about a 10% decline in the major indices in 2022. So basically across the board, NASDAQ, SP, they're expecting about a 7 or a 10% drop off on the markets. So interest rates, more important to me, more important to realtors watching this, the thing that drives our industry. So interest rates, they anticipate them to rise along with inflation during the first part of the year towards 3.75. So that's the base rate. You're going to see people with a lot higher rates than that, depending on their credit, depending on how much money they're putting down, all that fun stuff. But the base rate, perfect client putting down a huge amount of money, 800 credit score, their lowest elbow they'll get on a conventional loan is probably going to be around the 3.75 mark as it goes up, especially as inflation stays going up. So if the Fed takes action, we should see a softer stock market and slowing economic conditions, and then interest rates should head lower in the second part of the year back towards 3%, which I'm all for. And then so basically their forecast is rates are going to rise towards 3.75 during the first half of the year, and then as inflation gets under control, we should see a decline closer down towards that 3%. So a rise, and then inflation gets under control, rates come back down. Fingers crossed. It sets up for a bias of less upfront fees because of refinance opportunity ahead. So, a lot of times what lenders will do is as rates go up, they might, lessen their fees a little bit, knowing that, there's better chance of refis the higher rates are. You refied somebody last year, somebody got a new loan and refinanced their house when rates were at their lowest. It's going to be a long time till rates, if ever, rates ever go down that level again. So, we might have lost the opportunity to ever refi that client again. Whereas, rates go up and then rates come back down, someone buys at the market when the rates are higher, then, obviously there's going to be a refinance opportunity down the line. So housing forecast. So the way they view housing will remain strong in 2022, but not as strong as 2021. So they think it's going to continue to be strong, but not as crazy as it was this last year. Demand might be slightly higher or slightly softer due to a rise in interest rates, but still robust. So basically, less looky-loos. People last year, rates were so low. A lot of people are like, rates are so low, I have to look into this. I have to buy a house now. As rates go up, we might lose some of those people from the market that were just looking because rates were so low. And like I mentioned earlier, you're definitely going to lose some refinance opportunities. People are, I'm sure a lot of loan officers already have. They had, people lined up for refis. Over the last couple of weeks, rates have dramatically gone up. So, someone that it made sense to refi before, now it no longer makes sense because rates are higher. So supply will increase but remain tight. So we expect supply to increase. Or trying to make some moves on that front by building more houses, that kind of thing. but basically, tight labor still, supply chain disruptions, and semiconductor shortages play a role. So all this stuff over the last year, I know, there was, we had the lumber thing going on, and lumber prices were high. Worker shortages. Obviously, there's no contractors to do the work, and the house is gonna, you're gonna have a longer time to build the house. Semiconductor, electric. I know that was, there was some stuff, chips on the cars that was affecting it. So there's, across the board, no matter what industry you look at, plumbing, I know that, the copper and lead and different things that they, not necessarily lead, copper and PVC and stuff they use, they were, their supply chains were disrupted as well last year. So then, their side of things were taking longer. So all the different, subs involved in building a house have had some sort of effect either on their pricing, their labor, their materials, that kind of thing. Rents will continue to rise. So that's not a shock. Someone that worked in property management, I'm not shocked by that. Rents are just going to continue to go up, remain above 5%, pushing many people to see the benefit of buying. So that's the catch-22 there. Rates will keep going up. So, maybe it gets more expensive to buy a house, but with rents going up, then it's a wash. Another way to look at it too is if last year, if there was 20 offers because rates were so low, then that's going to, drive the price up. Whereas with rates a little higher, you might have less looky-loos, so you might have less competition when you're trying to buy a house. So that might keep it a little more reasonable. So you're not paying $100,000 over asking. So a lot of ways, sometimes it kind of balances out how things go. So their forecast for the housing is for mid to high single-digit appreciation, still providing a great wealth creation opportunity. So basically, not as great as last year, but still great. Still way better than renting. Buying a house obviously is a great way to invest in your future. So continue to, it still will be good to buy a house for the people that can pull it off. So, like I said, I just wanted to share that information with everybody. Like, it sounds like, like with the rates, we'll probably see an increase as the year goes along, with the Fed trying to get inflation under control. Once they do get inflation under control, we should see rates start to come back down towards the lower threes, which be good for our industry, obviously. So if anybody has any questions, please feel free to reach out. Give me a message on Facebook, give me a call, give me a text. I'd be more than happy to discuss anything with you guys. So I hope everybody's having a great day, and I'll talk to you soon.